Live. Welcome everyone. We're back with another edition with our founder Shashank and Mr. David Choi, founder and CEO of USD.AI. Welcome, David.
Hey, thank you for having me. Pleasure.
Hey, David, nice to have you. Would be great if you could just start from talking a bit about yourself and what USD.AI is, what you guys do, how you got started, and yeah, let's take it from there.
For sure. So USD.AI provides uh, financing with chips as collateral at
Mhm.
like very high level what it does. But what it creates is a yield instrument that kind of represents the interest rate of artificial intelligence and how much it costs to grow the infrastructure behind it.
Mhm.
And yeah, it's trying to solve a problem that traditional finance hasn't been able to solve, which is how do you make the debt of the GPUs itself um,
Mhm.
bec- become tradable? Typically, you see this for like real estate, you see this for houses, you see this for cars and airplanes, but you don't really see it for GPUs because
Mhm.
of its depreciating nature. So we kind of reconfigured how credit worked in order to facilitate the liquid debt of GPUs, which is what is necessary to make the self scale.
Oh, nice. And how did you get started with this?
We were doing we were building protocols for low liquidity assets before, whether it
Mhm.
was CryptoPunks to land to Tesla chargers to like you go down a list, and we found
Mhm.
GPUs as like one of the highest cash flowing assets in the world, and
Oh, yeah.
also a market without a very strong debt market.
Mhm.
Just not many derivatives, not ways to trade it, not many ways to scale it.
Mhm.
And that was kind of like we did our first loan. We were actually mining BitTensor and realized how much we were paying in cash for
Mhm.
rent. And I'm like, we should just buy the chip. And we couldn't get a loan. And that's kind of like the origin story.
Oh, nice. So for our users, so it's more like on the demand side. If I want chips, I can get a loan, pay you some interest, get those chips, and then pay back that loan. And since it's difficult to get that loan through banks because you can't put chips as collateral or something like that, so it's easy to do it with USDI. Is that how it works?
Precisely. It's not it's literally impossible to get a loan from a bank if you have anything under $100 million under really under like 300 mil. Like we've
Oh.
talked to customers who are looking for a 200 mil loan, which is pretty
Mhm.
sizable,
Mhm.
and yeah, they get like a 3 to 4 page deck from like a middle market investment banker, and they're like, yeah, you can't get a loan for this. You have to like sell equity and then raise it in cash. So it's
Okay.
dilutive and it's typically recourse.
Mhm.
Not us, but these other loans. So we're non-recourse in that
Mhm.
only the chip is the collateral. So
Mhm.
if default on the loan, we
Mhm.
only take the chip.
Okay.
But yeah.
And how much interest rate do you have to pay on those chips? Is it dependent on the type of chip you're buying through the loan?
Yeah, the type of chip matters less. What determines the interest rate, and these are the boxes that like
Mhm.
set by governance,
Mhm.
is is just who is a person that is making sure that they're paying down the rent. So
Mhm.
it's really about the tenant. It's about the
Oh,
person
okay.
who's actually using the chip,
Mhm.
and that determines the interest rate.
Mhm.
And that's usually just 15% at the highest LTV, which is the rule set that we have. That would be like 15% APR you'd pay
Mhm.
across like a 3 year term.
Mhm.
The lowest you can get if it's like a sovereign offtake, like
Mhm.
a nation or like something massive like a Microsoft, you would get
Mhm.
like closer to a seven.
Mhm.
Um, and but regardless, you can always get financing
Okay.
from 300K to 300 mil.
Mhm.
You can always get a loan.
Oh, nice. And who's the party that takes the risk and ensures that the loans get paid?
It's well, the chips are recourse. If you don't
Mhm.
repay, you
Uh-huh.
lose the chip.
Oh, okay. Yeah,
Yeah.
so there must be some legal structure there, right? That
Yeah, exactly.
you're getting into a legal contract and taking the loan, and if you don't pay up, then your chips get taken.
What matters more is where it's located.
Mhm.
So there's obviously I can talk about the legalese quite a bit,
Okay.
UCC Section 9 and all this other stuff. But the main idea is that it's not in someone's house.
Mhm.
It's in this rectangular um, facility called the data center. It's just massive. There's a fence around it. There's like better security for this stuff than like a free port or like military facilities. Like you literally just can't get in. And if they default, like it's not stored in their own house. It's not stored in their own facility. It's stored in the in a third-party location. So taking it is like one of the easiest things in the world. But yeah.
Okay, nice. And what kind of chips have you seen the most, like the loans taken out for? Is it H100s, 200s, or is it?
Yeah, we don't do H100s. We do only H200s and on, and likely we'll stop doing H200s pretty soon, just because of the life cycle. So we only try to do the latest loans, the latest chips. And that's kind of why the debt instrumentation, like typically if you get a loan for your house, and sorry to segue into this metaphor, but it's important. It's a 30-year mortgage, right? So it can take like 1 year or 2 years to structure 10,000 loans and make it tradable. That's how like this all scales. It's kind of like ETH staking is another metaphor for the crypto audience. It's like, you stake your ETH and then you make the derivative tradable, the wrap staked ETH. That's why it was called LSD-Fi at one point. That doesn't exist for GPUs because new chips come out every year. Right? There's some H100s, H200s, B200s, B300s. There was even a B100, but people forget it existed. There's the GB200s, GB300s, and every time it comes out, you get to this point where like, wait, what about the older ones? Like, I can't structure this instrument if it comes out every other year, and that's why we invented USD.AI. Because what happens is that we made a debt instrument perpetual, just kind of like what Hyperliquid does with features, right? It's every 8 hours, it's continuously going, and it's going. That's why it's a blockchain. It's forever. We did the same concept where instead of doing like, hey, synchronous, hey, let's do all these loans and we'll just structure. It'll take a year to structure. We do 10,000 loans. What we have is a continuous yield instrument, a yield-bearing stable. And that's giving loans to the latest generations and is paying down the older generations. So it's automatically self-refreshing, self-replenishing with the latest chip types. And that's how we solve one of the core issues that TradFi isn't able to solve. So we only give loans to the protocol only gives loans to the latest chips.
Okay, so is it like the older way of financing where it used to be like bonds and you have to pay monthly coupons or yearly coupons does not sit well for GPUs that kind of get useless after 1 to 3 years. So if you make the payments more continuous, then it kind of works. Is that what you're saying?
Yeah, so it's more so like the collateral base of the debt instrument that we have is self-replenishing. So you don't have to like, hey, because a lot like people try to do these ABS loans, but it's only against H200s and they're issuing it now. And I'm like, guys, you've issued this like 2 years into the cycle. You need to have a diversified base and it needs to continuously replenish because of obsolescence. Like chips, NVIDIA is so good, it makes its own chips obsolete, right? That is its own competition is itself. And without a debt instrument that accommodates for how fast it replenishes, you can't create a debt instrument, which is why, this is why I'm not sure if the audience follows like Wall Street Journal, but like Oracle can't borrow any more money. Why? Because we're trying to stuff all this capex into existing companies, when in reality you don't have that for real estate. You don't like have, I don't know, BlackRock borrowing more and more money against its own balance sheet and cash flows to buy houses, right? You usually have it against the house itself. This is like how the largest debt markets in the world have developed. It's like you need to have asset-backed financing. And this instrument doesn't exist. It's like is right now we're trying to scale AI with a two-legged stool, which is, hey, let's do private credit and let's do let's do like these like hyperscaler like cash flow financing, like based on the money they make. That doesn't work. You need to have the core like stump, which is how do you borrow against a chip in order to scale AI? That's why Oracle can't borrow my money. Private credit is done, right? Like they're not expanding. The redemptions are turned off. You can't borrow any more money. So you have to invent this this third option, which is the main option. It actually should be the only option, but unfortunately we went through these like side paths because we haven't been able to innovate on the traditional financial path. So this is very unique in that like a DeFi protocol solves an issue that traditional finance just cannot solve, based on the points I just made. And anyway, just give a little bit more color about why we exist.
Nice. I want to understand it a bit more. So is it more like the collateral itself is dynamic? Because
it's evolving organically. Yeah.
Okay. So if it was like you were just collateralizing one GPU, then it kind of like it's depreciating, loses its value over time, and the new inventory doesn't come in, so your loan kind of doesn't work. But in your case, new GPUs are coming up, and the older ones are also paying up for the new ones, and that's how the model kind of works. Is that how it is?
That's high level, and the best way to describe it is like asynchronous, right? It's TradFi is like, hey, how do you even structure a debt like thing, right? Well, you get a loan from like JP Morgan. It's called a warehouse facility, and you get like $1 billion that you can draw from. This is just like it's like a credit card. Thing is that credit card is like only permissible. They can only buy or get loans to buy H200s, and that's it. And this takes 2 years for you to do 10,000 purchases with the debt, and then you make the debt tradable, right? After a while, you're like, oh, this credit card's maxed out, $34 million, $3.4 billion, whatever, and then you make it tradable, and then people trade and buy and sell the debt instrument. Thing is, if it takes 2 years to do this, you're past the Blackwells, the B200s, the B300s. You're the Rubens, and you're the Feynmans. Like you're just so far ahead in the generation. So doing it like synchronous is just it's not the way you scale AI. It's not how you accommodate for obsolescence. So you have to make it like asynchronous, and that the moment a loan is originated, it's immediately tradable. You don't have to go through this long cycle of like, hey, let's just do all of it at once. It's more like, hey, whenever a loan is created, it's immediately tradable as a debt instrument into a single debt instrument. It's an evergreen, instantaneous debt instrument, and that sounds obvious to us because we're like, yeah, of course, everything should be evergreen, everything should be continuous. This is what blockchain is, and I'm like, that's exactly what blockchain is. This is why DeFi is beautiful, is that everything's a perpetual. There is no there's sometimes maturity dates like Pendle, but really what we can accommodate for is that you can create these evergreen, continuously priced and algorithmic processes that TradFi is not able to accommodate for. But yeah.
One of the things I also want to understand is when TradFi packages all those loans into one one asset, it also adds diversification because there's like multiple loans underlying that. In your case, it all keeps on getting added perpetually. So does it get more and more diverse over time?
It gets diverse if you're looking at assets that are 30 years long, right? That's when you want diversity. You don't want diversity if it's for 10-year-old chips, right? You don't want A100 loans in your book. You want only the latest generation. So the diversification isn't like the right word to use here, because that might make sense for like Fannie Mae if you're like, it's a mortgage for a 30-year home, because you can accommodate, because this is how long, if it's 30-year mortgage, this little bit here is how long it takes to structure. So yeah, you want a bunch of different 30-year mortgages. For us, like is this long, and then it's like there's new generations happening every time. So you don't actually want diversification, and frankly, there's no point, because most of these chips are entirely homogeneous. When you rent from a B200 here versus a B300 there is no physical wear and tear. Like that's not a thing. Like when people think of depreciation, they think of like a dilapidated building. These GPUs are air conditioned with warranty. It's like they're all pretty much the same. they want the latest generation. So you're trying to be at the frontier. So diversification isn't the priority. It's rather that you're trying to avoid diversification by getting to the latest generations every time.
Yeah.
You want the protocol to continuously be giving loans to the best and greatest, and you're kind of like chasing that. And you want the older chips to be at a lower LTV, which happens automatically, because if it's like a 2-year loan, like the loans are amortizing, so it'll be like started at 80. It's going to be closer to 20 to 30% LTV, at which you want them to default, because H100s are trading at almost par price 3 years out. By the way, our loans are only on average, most of our loans are 3-year. So like we assume that the chips are worth nothing as year 3. Like it's a 0% LTV loan. If it's trading at 100%, like if they default, we want that to happen. We would love for them to default, because it's so easy to repo these assets, right? It's the fact that it's asset backed is the most important thing, and that's why this isn't private credit. Private credit is like, hey, I'm going to give a loan to you based on your cash flows and some unsecured is the word that they use. Whereas we're asset backed. We don't care what you could be Alberts, right? You could be I don't care what you are, as long as you own the chips. Avi doesn't care about your FICO score. Avi cares about your ETH that's put up as collateral, and we only care about the GPUs as collateral. It's a very common sense thing that we're used to in DeFi. Like it's bearer assets. We only care about the collateral. We don't care about the person. We don't care about the company. We care about the chips. The chips are inside this perfectly isolated, like military grade facility that we just unplug and sell.
Yeah, nice. Yeah, I guess if it's only based on assets, then you don't really care about diversification. You would care about having the best possible assets. So if I can get it against H200s, I would prefer that instead of like worse off chips. Yeah,
and the permutations of underwriting risk, and that's kind of like the risk you saw with these money markets. Is like is even for like a morpho market, every time you add an asset, it does increase risk like exponentially, right? Oh, you have 3 assets versus like 17. 17's like literally like power laws more like risk, because each asset you have to underwrite the liquidity, the volume, the counterparties, the holders. It's just a lot of variables. For us, it's only 8 chips, of which when a new chip comes out, we just get rid of the old generation. Like when we still do H200s based on governance, but we're probably going to stop that pretty soon. Just get to the next one. Just said H200s are just so valuable today because all models are still trained on it. And we don't do H100s. Like very, very rarely we would do it at extremely low LTV. But it's not many chips. Like, and the beauty of it is that we're building rule sets that's governed by a protocol. Therefore, it's not you don't need a broker dealer, because it's not a manager based system. It's not a Goldman Sachs saying like, hey, this is what we think. It's more like, hey, as a protocol, we've decided that these chips are good. Much like Aave. Like Aave doesn't. They used to do this, right? They used to do like every counterparty in the very beginning in like 2018. But then realized, why don't we just set the king curve of a single asset? But our job is even easier because our permutations, the number of chips is so low, and the LTVs are so obvious. Just like, they just have to repay. And we don't have to monitor liquidity. I mean, we still do, but it's not like a hard requirement as something like money markets would require. But you really just have to monitor the cash flows, which is very publicly available information. But yeah, it's obvious for GPUs in a sense.
Nice. And where are most of your GPUs located?
Right now, it's where we are starting to just. So we are starting to expand to Asia quite a bit, and that's like with Australia as like our beachhead. But Europe and US is where a lot of the AI counterparties typically are, and that's where you can usually get. I mean, there's some emergence in like LATAM, but the question is who's actually going to pay the money for the rent? It's going to be US, right? It's going to be some Europe, and then Asia is rapidly expanding. So we are particularly interested. We're working with a private credit fund out there to be our origination partner. But yeah, it's for the most part, US is like where a significant amount of the counterparties are. Canada too. We're doing our first one in Mexico. Doing our first one in Sweden, stuff like that.
But the GPUs can be based in any country, right? And the counterparty could be in other places. Like it's cloud. It would just work from anywhere.
We tried to accommodate for like the best property right locations because again, like we have to repo the chips, and that is the priority. Is like, are the chips in a place where it's easily repoable? Yeah, I mean, I think the largest conundrum actually is that India is probably one of the world's best places for AI, right? Like there's so much demand for compute there, but it's also it's not a great place for you can count on your hand how many like portfolio managers have survived India historically, and it's just Blackstone. it's like Ares, like you just go down the list, Goldman, JPM, like they leave defeated, and it's hard to scale. Like I guess even like I'm talking about like real estate stuff, not even for chips. So it becomes quite difficult because of just law there. But at the same time, it is like every single new cloud I talk to, like even the top guys, you talk to Nebius all the way down to the CoreWeave, they want to go to India because it's just the cash flows there are it's like literally top 3 in the world, right? It's like literally US, China, then India. It's just I think people still trying to crack it, but it's difficult. And usually you typically need a government guarantee to get something even close. And there's even for government guarantees, which is the case where like, hey, they're not in default. There's usually layers to the government guarantee, and that like I've gotten I get these deals like straight from our like our institutional counterparties. Like think like I'm not gonna say which one, but think like Super Micros and the Nvidias. They send us deals, and I'm like, the number's kind of weird. Like why is the price of this chip like 20% higher? And then they just go cold because they're just trying to clip that spread. Anyway, just the deviation, just interesting deals that come in. But anyway, back to your question, it's like mostly US, mostly EU, and a rapid expansion in Asia. And we're starting to one of our bigger deals coming up will be in that region.
Okay, nice. It would also be good to understand how USD.AI works, like the tokenomics, how does it grow, and like for normal users.
Yeah. So the protocol itself, it's not fully required that the protocol itself could work without chip in the beginning. But now that we've really tried to decentralize the governance, chip is required, and that it's actively engaging in the underwriting of the chips. It's not engaging in underwriting of the counterparties. That is not what the protocol does, and it will never do. Nobody really needs to do that. They just have to underwrite the chips and the rule sets at which it's being represented. So the way the protocol works is that it takes all the loans against the chips, and then that's what's being deposited to get liquidity against these loans. And that's the basis of the protocol. Now, what does chip do? Chip is the one that's deciding the governance. It decides what we do with the cash flows as well, because you get about 10% net interest margin on USD.AI, and then you also get as well as yield related to USD.AI, and it also gets a 3% origination fee, and that's decided by the chip governance. We are exploring a more experimental strengthening enhancement of chip to the accrual of the value of the underlying. I think there's a lot of interesting discourse happening with buybacks, but I think there are better ways to accrue value, which is a common complaint you see. I mean, we can get to the philosophies of what token utility should be, but it seems like people trust equity more than tokens in this market. They're like, you don't need to do buybacks of your equity. I'm like, well, excuse me, like you're saying like I should go back to it's saying that you should go back to equity in a sense. And I think the like Hart Lambert with like a cross protocol was like, I mean, he's a very smart guy, like Goldman 2 Sigma kind of guy, right? Like and he thinks the multiple on equity is higher, whereas stuff like Hyperliquid, like the multiple on that is a pretty high goodwill premium. But they also do 100% of the cash flows to buybacks, and I'm like, then how do you build the business? How do you scale it rapidly? It becomes a question of like how exactly do you create chip value accrual? And I think there is a unified capital markets where you can play in both equity and token markets and crypto markets. And that's why like USD, I focus a lot on building out the distribution channels for the crypto venues, and that's why we did our launch a few weeks back. Robinhood all the way down to Korea, like Upbit and Binance, and also like Coinbase. But at the same time, I think there's an opportunity to also increase distribution and have value capture on the equity side, which we will announce pretty soon what we're going to do. But yeah, it's been an interesting philosophy of like where the right structuring of a utility and governance token like CHIP can be successful. And I just don't like the solutions that we have in the market today. And we are actively seeing like, how do we make CHIP not only a critical function of the protocol, but something that can engage institutional investors. And yeah, we're cooking in terms of trying to figure that out. I think it's a question that a lot of people want to ask. I think tokenized equity is like an interesting play, but I think it's just it's not taking advantage of what you can do with tokenomics. Anyway.
I mean, several projects have tried token buybacks, and in almost all the cases, they haven't really worked that well. If you look at Jupiter and others, they were like,
yeah, exactly.
Yeah, we do buybacks, but it doesn't help the token price. It prevents you having a war chest to actually grow your business. So it's
exactly
worst of both worlds. So yeah, I think a lot of improvements will need to come in this area to have some sort of in between of token and equity, so both can be happy.
I think like the cases that it works is like extremely high cash flowing businesses like BNB, Tron, or like and Hyperliquid. That's when it does well. But like Pump Fund, Jupiter, like they try to like copy the playbook, but it just doesn't seem to work that well. And I think there's a large distrust of like, hey, what exactly is happening behind the scenes? People are like, hey, the team's selling. I'm like, no, I think other people are just selling, and some people buy. It's just, I think they're just looking for someone to blame because it's just a low trust market. But in reality, like maybe you can create a system where it's unblameable. And it really is like that methodology, and that's something we're actively looking at. Like we do want to be unblameable in that, like, hey, this is just the market as the market is. I think quasi equity is kind of like where things are evolving into. It's going to be in between. I also just don't think they're different markets. Like people are like, hey, you have a DAT, and then you have the crypto markets. I'm like, it's really just the protocol that sits underneath. The question is how you represent it in a clear fashion. And right now, the way our protocol is designed is that any cash flows generated by the protocol, whether it's origination fees or the net interest margin, is actually controlled by the token holders. Like it has to go through to the protocol itself. People are borrowing from the protocol, and it's not like, hey, we're doing the loan, it's going through our C Corp development company. It's actually going straight to the protocol. And making that radically transparent is the path forward. But being creative into tokenomics, I think we're still working on, because it's a big question. It's a project in of itself, and we're being very particular on how to do that first before we go to the public. A lot of people have like, hey, why isn't that? I'm like, well, I can't design this in a single day. It's going to take a little more thinking, but we're pretty close.
Okay. By the way, what are the yields on USD.AI right now?
I think it's like close to 8% right now. And then with this, let me check right now. Close to 8% right now. 7.5 at around 356 deposits. Goal is to obviously get up to $1 billion of loans originated with the systems that we created. But the yield scalable. I mean, we're actually the highest yield that's above 100 mil of TBL. That's stable. There's vaults, but we're the highest yield bearing in terms of APR, in terms of yield bearing stable, and it's scalable. Like it's literally the greatest use of it is the greatest expanding credit market in the world. People, the SaaS is crashing, as we all know. SaaS is like it's over. It's kind of like buying altcoins in the like last 4 years. People will try to rebid SaaS, and it's not going to bounce back because you're one prompt away from being abstracted away by these 3 large corps. But you also can't give a loan to an AI company. Right? Like you can't give a loan against this cash flows AI company because most of the money that's being used in an AI company isn't actually being used for salaries. It's not being used for, growth. It's being used for compute. So almost all of, think about like Anthropic. People, oh wow, these guys are getting paid like millions of dollars. I'm like, that's a bucket. That's a drip in the bucket compared to how much money they're spending on compute. Right, it's like 80%, 90%. As an AI company, like it's most of the costs on your balance sheet is in compute. So what you can really only give a loan to is not the SaaS company that's dying. It's not the AI company that's not like stable cash flows. It's really against most of its expenses. It's against the compute. So I think GPU financing is not a niche. It's actually just the entire future of credit. Like Bloomberg will just look at GPU financing. Like that's my thesis. Like it's just going to be CapEx. Like the rest of the spending that you see for the next 10 years is going to be CapEx. And CapEx is not financed with cash. It's financed with debt. I don't know where I was going with this. So I just going off. But yeah.
Yeah, that's a nice way of looking at it. So, by the way, how did you come upon designing USD.AI as more like a yield earning stable coin and not like other token designs where there's some buyback and burn mechanism where you buy the token and when you make money through loans, then you burn some of the token and then the token value goes up by a certain amount. Like, what was the thought process behind designing it this way?
Well, just DeFi compatibility. I think a lot of DeFi is just like an accounting format solution that gets the benefit of perpetuality. So it was just. There are some protocols that like try to use like their own like a render, right? They try to use some like non-pegged like yield bearing instrument, but like all GPUs are priced in dollars. So inventing like this floating currency for payments doesn't make much sense in my opinion. So it's just what are chips denominated in? They're denominated in dollars. So an interest rate is the most important method of communication in finance. And an interest rate for chips doesn't exist. And that's why we designed it as an interest rate. So it's less so like, hey, this is yield bearing stable. It's more like, hey, this is an interest rate that's baked into the calculus of a numeri, right? It's just like a 1.0. It starts from 1.0, it goes up.
Okay. Yeah. By the way, do you think there can be more derivatives on top of these? So if the interest rates are fluctuating right now, I guess they are fixed, right? Whenever someone
all the loans are fixed and it's based on utilization. But people are, if there's a lot of like discussion. I think Larry Fink just announced like, oh, you have futures markets that compute. I'm like, I don't think so. It's a little controversial. People are like, oh yeah, you're gonna have like jet fuel like hedging markets, and I'm like. But that's because most of the costs associated with running these things is associated with the price of oil. But this is far closer to a mortgage market, a real estate market, right? People are renting, there's tenants. And the cost of compute isn't based on token burn. It's based on paying down the debt of chips. I think there's a lot of, what you're seeing right now, just for those who are curious about the evolution of like the compute sector and like the token factory sector rather. So AI calls it a token factory. Like you have, data center and it generates has chips inside of it and it generates tokens. Now you have these companies that are trying to increase how many tokens you can generate per GPU. You see, and this is like the base 10, right? This is like the sale research kind of thing. Like it's like the hottest sector in VC right now. Like how many tokens can you really generate from a single chip? Because we're chip constrained and we're energy constrained. So how do you like improve the efficiency? But almost all of this is like everything in the compute sector is that you're paying NVIDIA, yes, but you're really paying Wall Street. NVIDIA has $500 billion of sales for the next 5 quarters. And you're really paying $600 to $700 billion on 500. Like, why? Why are you paying this 20-30% premium? Because you're paying debt. You're not actually buying chips. You're buying chips with debt. And so it's kind of like a mortgage on a house. You're not paying $1 million for a house. You're paying 2 to 3 across the next 30 years. And here you have what I call the second largest business in AI. It's Wall Street. It's they're capturing this massive spread. And Wall Street is looking at where money goes. And it's going down to paying the debt. You're really trying to hedge interest rates. You're not actually trying to hedge token pricing. You're not trying to hedge compute pricing. Nobody in real estate trades cap rates, which is the rental rate. Nobody trades Airbnb rental rates. They don't hedge it, right? What they really do is that they hedge the mortgage rate and the debt rate, because that's the real cost of capital. That's where most of the money in AI is being spent towards, is actually just paying down Wall Street. It's hard for me to say this out loud because it's just like, I think a lot of people think it's like, oh yeah, you're paying down for compute. I'm like, no, you're not paying down for compute. You're paying down debt providers that's financing via like a Morgan Stanley roadshow. Anyway, so I think when it comes to like the use of the interest rate and the derivatives is that you are going to hedge the interest rate. You're going to create all these derivatives on top. And that's why a lot of people trade our yield rate on Pendle. It's one of our largest markets.
Yeah, nice. How do you see the growth of agents? Like we have talked a bit about infra, like we have talked a lot about infra, how interest rates, now the mortgages on GPUs, but finally it all leads to AI and the users are going to be agents. How do you see the growth of agents? Do you believe most transactions in Web3 will be done by agents and soon?
Well, first off, agents are the UI layer. I'll say that. This is Jensen's 5-layer cake, right? Like it's like energy, chips, infra, models, and it's apps, and apps are just agents. That's the 5-layer cake. Jensen Huang says it a lot. It's on his website, NVIDIA.com. Now, I think agentic commerce, the part I can discuss, is completely misunderstood. I think everyone they think it's like a baseball in the mitt, right? They think like, oh yeah, I'll send you money, you catch it. Suddenly, all the agents in the world is going to settle their eBay transactions and stablecoins. And I'm like, that's retarded. That's like the most rudimentary analysis of what they think agent should be. It's like, oh yeah, you're just gonna send a message and they're gonna pay. I'm like, okay, what are you doing for what are you doing here? Like, what's actually being solved? Like, oh, you've created intents, but for like purchasing on. I'm like, it's like when people like try to start a neobank because that's the only finance that they know. It's like, oh yeah, you just deposit money in a bank, and then that's how banks work. I mean, no. There's investment banks. There's B2B corporate like finance. There's derivatives, right? And that like a neobank does not do derivatives. So when somebody tells me that they think the future of Web3 AI is going to be related to sending money to settle transactions, I'm like, you've completely misunderstood what the number one issue in AI is today, and that's compute. The first thing you should solve is how do you pay down compute in stables? How do you lower the cost of capital for compute? Because compute's 90% of every single cost. Why does AI companies fundraise so much money as to pay down compute? Well, what is the purpose of VVV and DM? It's pay down compute. I think VVV is like more agentic commerce than most of the new startups that are looking at AI agents, because I'm like, what is even like Truth Terminal all the way down to like 0x Sigil? These are memes, right? Like an autonomous AI agent, like we're still too early for that. But what is the objective of that platform? Is to pay down the compute, because you have to make sure that your profitability, based on the compute that we have today, is going to be higher than your cost of compute. Otherwise, you're just giving money to NVIDIA. You're giving money to CoreWeave. You have to make profit off them. But I think agentic commerce is really compute commerce. It's not agentic commerce. And if you can figure out how agents can pay down the debt, namely pay down the compute, it's like paying down the mortgage. That is the product that people are trying to accommodate for. It's like you just have to have a positive carry, and the cost is compute. The profitability is agent. Trading agents are actually, I think, are actually probably the first, like from first principles, is thinking correctly, is that you're actually making money to cover the cost of compute. But I think if people try to pitch anything with AI agents and they're not addressing compute as like the first thing they're trying to solve for, it's ignoring that. And none of the rental platforms, besides like OpenRouter, like VVV, they accept stables because they don't really see a need for it. Like, why pay in stables? We're actually introducing our first instrument for these compute providers, these like large neoclouds and small neoclouds, is that if you pay in USD.AI, we will actually subsidize their compute costs and the rental costs. Now, how does that work? Is well, the study of like of credit cards, so that you make money on interchange. So whenever you do a transaction between any you credit card, you at the swap at which you pay, people charge a fee, 3% fees or whatever. You don't actually have that issue in stablecoins. So what the way you make money is actually in between that transaction. When you're holding USDC, you're giving up the T-bills that you're earning because you've tokenized the settlement currency, which is USDC. So most of the money is actually in the stablecoin. The question is, why use USDC? So I think the greatest business to be created from Web3 and AI is actually not the settlement of it's not the payment of these assets. It's actually the creation of a new stablecoin that is going to be the new winner in this AI war. It's like it's not going to be USDC. It's not going to be USDT. It's going to be something else. And the only thing that you would actually want to accommodate for in this design is to lower the cost of compute. It's going to be a stable coin that's connected to compute. That's our thesis, at least, because I really just don't see the value proposition of paying an eBay transaction with an agent that uses stablecoin. I'm like, it's marginally beneficial. And whereas what will be beneficial is like, how do you financially engineer a lower cost of compute? Because that is where I guess DeFi would be most interesting. Because it is by far the most important thing in AI today. Is like, how do you deal with this compute bill? It's insane. Like it's gonna be like $20 trillion for the next 10 years. We have to subsidize that by a few more. Anyway, that's my very ephemeral take on agents. It's like, I think AI agents has to have compute in the pitch, otherwise it's not a real pitch.
So you're looking agent as an actor which can generate some value, and it also takes up some value in the form of compute. So unless that the difference is positive, then you aren't really talking about agents. So like there has to be compute in the discussion.
Compute has to be the first thing that you address. Compute-related transactions, and there's very little innovation in this. Like, people are actually like going to a neocloud or these rental platforms and asking like, how do we play into this role? Even like if you go on like OpenRouter, like you're paying a massive like Coinbase Commerce fee, like 3%. Like, it should be 0. That's why VVV is like somewhat interesting. It's all paid in stables, or paid in DM, which is like accompanying for that cost. But that's where the real margins are being accommodated for. But then how do you actually use the financial system here to maybe even give them the credits? So it was a cool idea where somebody's like, hey, what about a credit card where you get cloud credits? I'm like, a personal card would be meaningless, but something more corporate where like, hey, just by using your financial system, you can get a subsidy on your credits would be where things are there. And that's what DM really is. But DM, I think, can take it a step further. They can go further down the value stack where you can go directly to the chip itself, because they don't interact with the chips. They just interact with the API costs. Anyway, yeah.
Nice. That's a great way of looking at it. Okay, so we are almost out of time, so let's move on to our next section, the rapid fire round.
Hey, David. So we have like a few questions for both of you. First one is with you. And so, David, you've spoken about going from 1.6 GPA at Rutgers to actually teach in there. Is there something that the streets of New York taught you that classroom didn't?
So 1.6 of what?
GPA, right? At Rutgers. Oh, maybe the info is incorrect. But anyways, you teach. You taught as an adjunct teacher, right?
No.
No. Okay.
I worked at a bank.
All right. So that's not. Okay. So the next one is actually for both of you, which is, what's the most fun you had training AI agents?
Can you be more precise? Like more fun at what?
The more, for example, you train an AI agent and it turns out to be like much better than you thought, exceeded your expectations.
Yeah, David, you want to go first?
No, you go first.
Okay, it's from a while back. During our AI course in college, we had an assignment. There was this board game called Order and Chaos, where you had to create an AI to compete with other students' AI, and our grade was based on that. So yeah, we created a good reinforcement learning environment, and the agent played against itself, got better over time, and finally we won, and it was great. Like being able to be better than all other agents out there.
Okay.
I feel like I've gotten to the point where I'm not having fun with agents. I'm just getting annoyed at their inefficiency. So I mean, like Claude is like moving towards skills instead of like agents. Like, it's like, oh yeah, you have Claude skills, and I'm like, gosh. And then I train all my like Claude agents, and I'm like, now I'm going to Codex. I'm like, this is annoying because Claude sucks now. Because of compete constraints, by the way. Let's wait until that XAI deal kind of closes. I mean, what we've been doing at the company is that we've been whenever there's a call. I mean, Fireflies is my favorite thing in the world. Just like it automates all the noting. But how we turn that to like facilitating a faster underwriting process. It's like something we're developing from scratch. Like, how do you first have the engagement of the call and just really make it programmatic in terms of like, hey, first call. Is it following the rule sets established by the protocol and tying it back to like us humans? It's almost like rent to human. Like they're rent to humaning Premium Labs to facilitate the protocol, and that's just like taking these calls. And we're not doing any underwriting at the company level. We're doing underwriting at the chip level. So how do you make the agent more involved in this process? So I've been having fun with that in terms of like simplifying the qualitative work in a financial process into something quantitative.
Nice.
All right. Next one is for you, Shashank. What's the hardest human task to teach an AI agent?
There's lots of them. The learnings of AI is pretty jagged right now. It does something really well, which I'm surprised a lot of times. So there's a lot of ML tasks I used to do back in Goldman, which now when I ask AI to do, it just takes care of small things. But whenever it messes up, it's like the simplest of things. I'm like, you can be this smart at doing this complex stuff. How can you be so stupid at doing this? So yeah, that's kind of how it works.
All right. The next one is for both of you. So what's one founder habit that no agent should copy?
Vision. Can't. It's just like nobody's going to follow an agent for what you want to build.
Oh, good one.
Yeah, sounds good.
All right. So, and the last one, also for both of you. So if you weren't in crypto, AI, or finance, which sector would you be in right now?
I'll probably be VR.
Okay, VR.
Yeah. I mean, something related to computer vision, even if not AI, because the first thing I ever did was identifying tumors from MRI images. So kind of something around that. Initially that wasn't deep learning on AI; it was just basic computer vision. But yeah, it was fun as well.
All right, so that concludes it. Thank you so much, David, for joining us. Everybody, please follow David and follow USD.AI. They're linked in there, and see you guys in the next one.
Yeah, thanks a lot, guys. Thanks a lot, David.
Thank you.
Bye, everyone.